The currency market is where currencies from countries around the world are traded. It plays a crucial role in the global economy because it directly impacts exchange rates, which in turn affect the economies of all nations. This market facilitates international trade, investment, and currency value adjustments. It also makes buying, selling, and investing between countries more accessible. Understanding the currency market not only helps you seize investment opportunities, but also gives you a clearer view of the factors that influence the global economy. So in today's video, let's explore the basics of the currency market and understand how it operates. I am Drake Lay. The knowledge shared here is gathered from various sources and personal experience. If there's anything incorrect or in need of clarification, please feel free to comment below. Let's begin with the first concept. What is an exchange rate and how does it work? At first, let's see what is an exchange rate. The exchange rate is the value of one currency when exchanged for another currency. It shows the price at which one type of money can be traded for another. For example, 1 USD can be exchanged for 0.96 EUR. This means that with $1 you can buy 0.96 EUR. Because of its nature, exchange rates greatly impact international trade. A strong currency makes a country's exports more expensive, reducing global competitiveness. Conversely, a weak currency makes exports cheaper, boosting international sales. There are two types of exchange rates: fixed exchange rates, set and maintained by governments or central banks. Floating exchange rates, determined by the market, based on supply and demand for currencies. Exchange rates also matter to investors because they directly affect the returns on international investments. For instance, if you earn $5,000 monthly and the dollar's value rises, you'll get more local currency for your earnings. What influences exchange rates? In general, exchange rates change constantly due to supply and demand in the market. When the demand for a currency increases, its value goes up, and vice versa. Other factors include interest rates, inflation, economic conditions, and more. Let's break them down in detail. Interest rates. Interest rates are one of the most significant factors affecting exchange rates. Countries with high interest rates attract foreign investments, increasing demand for their currency. When interest rates rise, investors move money into that country to benefit from higher returns, boosting its currency value. On the other hand, lower interest rates cause money to flow out, weakening the currency. Inflation. Inflation measures the overall rise in prices for goods and services. A country with high inflation will see its currency lose value. For example, 10 years ago, a bowl of PHO cost $50. Today, the same bowl costs $100. When inflation rises, a currency's purchasing power decreases, making exports more expensive and imports cheaper. This leads to trade deficits and lowers the currency's value. Balance of payments. The balance of payments includes all economic transactions between a country and the rest of the world, like trade, investments, and money transfers. If a country has a surplus, meaning more money flows in than out, its currency value increases. In contrast, a deficit leads to currency depreciation. Fiscal and monetary policies. Fiscal policies, government spending and taxation, and monetary policies, money supply and interest rates, strongly influence exchange rates. Expansionary fiscal policies, increased spending or tax cuts, and loose monetary policies, lower interest rates, increase the money supply, reducing currency value. On the other hand, restrictive policies strengthen the currency. Economic activity. A country's economic performance, including GDP growth, unemployment rates, and industrial production, affects its exchange rate. A strong economy with high growth and low unemployment attracts foreign investment, boosting currency demand and value. A weak economy, however, causes currency depreciation. Stock markets. A country's stock market also impacts exchange rates. When stock markets rise, they attract foreign investment. Investors buy stocks, bonds, and other financial assets, increasing demand for the local currency and driving its value up. Political and geopolitical factors. Political events can create significant exchange rate volatility. Elections, political crises, armed conflicts, or international tensions can shake investor confidence. This leads to capital outflows and lowers currency value. Foreign reserves. Foreign reserves refer to the gold and foreign currency a country holds for international transactions and currency stability. As mentioned in Money Heist Season 5, gold reserves aren't used for trade. Instead, they create confidence among other countries, signaling financial security and reliability. Nations with large foreign reserves can stabilize or adjust exchange rates, boosting investor confidence and maintaining currency stability. Speculation. Speculation occurs when investors predict future market movements to profit. For example, if someone buys short-term crude oil futures, expecting prices to rise, they can sell later for a profit. Similarly, large-scale buying or selling of a currency by speculators can cause significant short-term fluctuations in its value. Market sentiment. Market sentiment reflects investors' emotions and expectations about economic and political conditions. Optimism about a country's economic prospects drives currency demand and increases its value. Fear or uncertainty, on the other hand, leads to sell-offs and currency depreciation. These are the key factors influencing exchange rates. As you can see, they are complex and interact with each other in many ways. Understanding them can help you anticipate and respond effectively to market changes. Now let's dive into the participants in the currency market. The currency market is a complex network involving many participants, from large institutions to individual investors. Each participant has a unique role and responsibility. First, central banks. Central banks like the U.S. Federal Reserve Fed or the State Bank of Vietnam play a crucial role in managing monetary policy and maintaining financial stability. They intervene in the currency market by adjusting interest rates, implementing monetary policies like quantitative easing, and managing foreign reserves to control exchange rates. Second, commercial banks and financial institutions. These are the main players in the currency market. They engage in Forex transactions to meet client demands, manage risks, and seek profits. They participate in spot trades, forward contracts, swaps, and derivatives to optimize profits and manage risks. I'll explain these in detail in the next section. Third, multinational corporations. These companies enter the currency market to protect their profits from exchange rate fluctuations, especially when they operate in multiple countries. They use forward contracts and swaps to lock in exchange rates for international transactions, avoiding risks that could impact their profits. Fourth, individual investors and investment funds. These investors aim to profit from exchange rate fluctuations. This group includes individual traders and large investment funds. They analyze the market, predict exchange rate trends, and execute currency trades. Large investment funds often use complex strategies to maximize profits. Fifth, Forex Brokers. Forex brokers provide platforms and services for individuals and organizations to trade currencies. They act as intermediaries between buyers and sellers in the currency market. Brokers offer trading tools, market information, and help clients execute trades. Some brokers also provide financial leverage to boost potential returns, though this comes with increased risk. Sixth, governments and international organizations. Governments and organizations like the International Monetary Fund, IMF, and World Bank help regulate and support countries in maintaining financial stability. Governments may intervene in the currency market through fiscal and monetary policies, while international organizations provide financial aid and policy advice to countries facing financial difficulties. Seventh, independent traders. These are individuals or small groups trading currencies daily to profit from minor exchange rate fluctuations. They use online trading platforms and apply short-term trading strategies to seek gains. Eighth, automated trading platforms. Automated trading systems use algorithms to execute currency trades without human intervention. These platforms analyze market data, make buy-sell decisions, and execute trades automatically, enhancing speed and efficiency. And that's all about the participants and their roles in the currency market. They trade using various tools and strategies, helping investors optimize profits and manage risks. Now, it's time to explore the most common tools and effective trading strategies. First, let's talk about spot trading. Spot trading involves buying and selling currencies at the current exchange rate, with transactions executed immediately or within 2 business days. This is the most common form of trading, ideal for short-term transactions and simple to execute. Next, forward contracts. A forward contract is an agreement between 2 parties to buy or sell a currency at a predetermined rate at a future date. This tool helps mitigate future exchange rate risks, commonly used by businesses engaged in international transactions. Then, swap contracts. A swap contract involves exchanging one currency for another for a set period and then swapping them back at the end of the term. This tool is often used to manage exchange rate risks and yield differences between currencies. Finally, options contracts. An options contract gives the buyer the right, but not the obligation, to buy or sell a currency at a predetermined rate within a specific time frame. This tool protects investors from unfavorable exchange rate fluctuations, while allowing them to benefit from favorable ones. These currency trading tools are applied in different scenarios. Investors also use various trading strategies, which can be divided into basic strategies and advanced strategies. Basic strategies can be further broken down into trend trading. This strategy involves identifying and following the current market trend. Investors use technical analysis tools like moving averages, MACD, and RSI to identify trends and entry points. Counter-trend trading. This strategy focuses on finding trading opportunities at market trend reversal points. Investors often use technical indicators like Bollinger Bands and stochastic oscillators to spot potential reversals. News trading. This strategy is based on economic, political, and financial events to make trading decisions. Investors monitor economic calendars, financial reports, and significant news to predict market impacts and place buy-sell orders accordingly. Advanced strategies include carry trade. This strategy involves borrowing a low-interest rate currency to invest in a higher interest rate currency, profiting from the interest rate difference. Investors often select currency pairs with significant interest rate gaps and hold positions long-term to capitalize on both interest and exchange rate fluctuations. Technical analysis. Trading. This strategy relies on analyzing price charts and technical indicators to make trading decisions. Investors use price patterns, trend lines, and indicators like MACD and RSI to identify entry and exit points. Fundamental analysis trading. This strategy evaluates economic, political, and financial factors of countries to predict market trends. Investors monitor economic indicators like GDP, inflation, unemployment rates, and monetary policies to make informed trading decisions. In summary, while there are numerous trading strategies in the currency market, it's essential to thoroughly research factors affecting exchange rates, financial tools, and trading strategies before diving in. Remember, knowledge is power. If you're a beginner, start with small capital to familiarize yourself with the market and minimize initial risks. Here's some advice to master currency trading. Combine multiple strategies. Don't rely on just one strategy. Combine various approaches to capture different opportunities and reduce risks. Monitor and adjust. Regularly track your strategy's performance and adjust as needed. The currency market is dynamic, so your strategy must adapt. Practice patience and discipline. Currency trading requires patience and discipline. Don't let emotions drive your decisions and always stick to your trading plan. So, in today's video, we explored the currency market from basic concepts to the complex factors influencing exchange rates. Exchange rate fluctuations can lead to significant losses. If you invest in a currency and it devalues, you'll lose money. However, if you grasp market trends and make accurate predictions, you can achieve substantial profits. Understanding the currency market not only helps you seize investment opportunities, but also mitigates risks, enabling smarter decisions in personal finance and business management. Thank you for watching this video. We researched and gathered insights from various sources and personal experiences. If there's anything missing, please comment below. Don't forget to subscribe to Drake Lou so you don't miss our next exciting videos. Goodbye, and see you next time.